So one of the things that caught my attention as you were talking, as I read the report, because we did get a pre-reading of it, was this issue about Los Angeles. And we talked about the Los Angeles market. I know both of you guys are very, oh, and I guess I forgot, I need to introduce my panel, goodness. So I have Mitch Menzer, who's with Cox Castle, partner there, has been a real estate attorney for quite some time, a great deal of expertise in helping his clients and obviously working with a diverse group of investors and developers and cities and the like. And then I have Gino Canori, who's the president of Related California, joining us. So again, very prolific developer here in California, kind of across the state, in a wide variety of markets. And obviously my colleague here, Moussa. Okay, so now I will dive into LA. So as we talk about Los Angeles, Moussa, you made an interesting point. It is a very challenged market. And we have this, me as the urban planner, I love that term mismatch, right? So we have a mismatch of supply and demand in that market where we have a tremendous amount of supply. People don't really want to be living there. It's kind of this, we talk about, these low vacancy rates and high rent, and it's so unaffordable, and yet here is a place. So, I'd love your thoughts about, is that a true statement? Do you agree with Moussa in that? And if that's the case, then what do we do? What are the fundamental issues? You guys developed there thinking it was going to be one way, right? So we'd love your feedback on that.
Okay, I'll lead us off here. Loaded question, but I think you need to take a step back and sort of understand what's evolved since COVID, right? A lot happened. You had a lockdown, as we all know. You had people leaving cities, San Francisco, Los Angeles, going to other places because of flexibility in the work environment. In addition to that, you had essentially unrest in a lot of these cities where there was a lot of apartment supply. And then you had overstimulus to correct the problem with COVID and the issues with the employment and things going on there. What happened as a result of that was an increase in operating expenses, utilities, turnover costs, up over 100%, insurance went through the roof. And so when you look at what's happened to high operating business models, right? Hotels, senior housing, and multifamily housing, the system has not quite absorbed all those increases yet. And in addition to that, you have labor issues, right? Because of affordability, and we'll get into that later, which is a much larger problem, and we need to speed that up as fast as we can on delivering those units. But we are now competing with other cities with better tax environments, lower cost of housing, also transferable disciplines into the management and the construction and development of some of these other cities, right? For a while, our weather was great. We didn't have to compete with that. But when you put all of that into the box of, multifamily ownership and what it means to downtown Los Angeles in specific, it's hard. It's a hard one to adjust. And if you were delivering product coming out of COVID, you blew through the interest rates. Now, all of those problems are absent the increase of interest rates, which were unprecedented, right? To sort of deal with our inflationary problem. So we can rewind and say that was a black swan event, suck it up, put your head down and keep moving. But fundamentally, at least specific to downtown Los Angeles, it has significant issues to quality of life, and the political system is not quite caught up with that yet. And people are going to continue to vote with their feet in some capacity until such time that turns around. So our buildings in particular are full, no complaints there. The rents associated with where we thought we were going to be is probably 15% below where they should be in 2019. So everybody has adjusted to keeping your buildings full. There's not much of any supply coming online in the next 3 years because it takes so long, but you have to absorb all of that other stuff. And that means land value for future development is worth zero. It's negative in San Francisco. And the cost to build these buildings is not getting any cheaper, and it's not going to get any cheaper for the reasons that I just explained with regards to where operating employees are moving to. So are construction, And that's even before you start to digest a lot of the infrastructure projects that are in the system through the Build Back Better bonds and other things that have been funded to the government. Now we'll see what happens with that in the current administration. But there's a lot to absorb and adjust. And I think when you take a step back and you digest all of that, it's going to be a lot longer. Now, if you're starting from scratch and you were able to price in current land value in some of the the good markets in town, great. If you were underwriting fair expenses, great. Like there's someone in the audience now who's got a great deal in the Inland Empire, ground zero, but he's nursed it through for a year, and his returns are great, but he's now priced everything in. But if you got caught in the middle there, it's going to constrain you from creating and delivering more product.
And Mitch, have you seen much work I'm just still kind of in that downtown LA CBD work, from your clients and your perspective on it. Are you seeing similar things to Gino? Is it, slightly different view of the world as you have people that are looking at conversions or looking at acquisitions or other things?
Well, downtown is certainly seeing a lot of challenges, and it's taking longer than we had hoped for it to start to respond. I think it's still in a state where rents are going to be soft there. Restaurants and the nightlife that actually animated and drove a lot of the growth in downtown is still pretty weak. Return to office is a huge factor downtown, so it has its challenges, beyond just dealing with the economics and making pro formas work. And I did want to just add that Moussa, thank you very much for a great job, but particularly for focusing on supply and regulatory environment, because these are huge factors, and also the migration is really significant. A lot of studies of this kind don't bring that in, but it's very concerning that we're losing population, particularly LA County, City of Los Angeles. I don't know if you have statistics that are specific to the city, but in terms of trying to sustain an economy when you're losing population net and you're losing customers in effect and tax base, what do you see as driving that, and what do you see as the ability to change that more quickly? And why is it bouncing back, do you think? It's diminishing.
I think part of the decrease in migration we see is just due to the fact that, the destination cities are becoming a little bit more expensive. I'm really thinking about the Inland Empire. So now if you're talking about downtown Los Angeles more specifically, it won't be a desirable location for everybody, right? If you have kids, probably downtown Los Angeles is not where you want to move, okay? Because it lacks some of the amenities, some of the services. But I think there are some low-hanging fruits there for policymakers to, address, to deal with some of these issues to make it a little bit more attractive. And maybe in the short term, what's required is really to put in place some type of subsidies to help people move to the downtown area. Because vacancy is quite high there compared to everywhere else. You're talking about somewhere between 7 to 80%, and vacancy has been very high. Maybe help people move there. And I think over time, these services people are really talking about will basically just rise endogenously as the need is there. You cannot start by saying, let's create those services so that people want to move there. That's not how things should work.
Yeah. Well, along those lines, we talk about maybe making it more attractive for investment. I can't help, and I promise I won't dwell and dig into all of the bad things, but these are top of mind as we kind of read the report. We're thinking about what's happening in LA, but Richard wrote his paper on ULA and some of the impacts of that, his white paper for this report. And so I thought it would be useful, before we maybe get into some of the other markets and kind of do a little bit of a comparison. Does that insult? Is it an insult to injury in terms of the goal to increase supply, to your point, focusing on the supply aspect, Mitch, or do we really feel like damage was already done and it's, we're kind of are where we are? I'm curious to get all of your thoughts on that.
I see it as a very much an additional barrier, an additional hurdle to not only new residential development, but development of all kinds. I mean, it doesn't apply just to multifamily. It applies to industrial, every type of real estate. So this is a very, very significant problem. I'm really glad Richard wrote that article and teed up the fact that it is having an effect on the number of transactions that are taking place. It's suppressing that. And there's a lot more research we need to do to show what the effect of Measure ULA is. I think most investors and developers, immediately realized that this is a very large tax on the front end and on the back end. So acquiring land or acquiring property, there's a big hit. And then building a pro forma and looking at the disposition of the assets 5, 7, 10 years out and modeling that, it's a huge hit on returns. Yeah. Depending on, because of the way it's structured. It's also, Measure ULA is very rigid in terms of how the dollars are actually used. And at most, about 40% of those dollars are going to be used to be available to build new supply of affordable housing. And the amounts that are being realized are much lower than projected, and therefore the amount of new affordable housing that can be built. Measure ULA also has prevailing wage and project labor agreement requirements, so the housing that's going to be built will be quite expensive. And it really raises a fundamental question as to whether it's going to suppress new development to an extent that is outweighed by this small additional amount of affordable housing that's built. So it's something that, in the city of Los Angeles, the real estate industry is going to have to tackle and grapple with and find a way to fix it. I hope this will be the start of more research at the Lusk Center, more discussion about from everybody in here. I do want to talk about the regulatory environment in the city of LA as well, because there are some good things that are actually taking place. The city had a huge amount of housing that it needed to zone for as part of the housing element process. So 450,000 new units had to be zoned for, and the city is about to adopt probably later this year, what's called the Citywide Housing Incentive Program, which is actually 5 different ordinances wrapped into one, but intended to create about half of that new zoning, so about 250,000 units. 2 aspects of it are quite interesting. There's a continuation of the Transit-Oriented Communities Program, which was quite successful actually in stimulating a lot of new entitlements around transit, because that provides density bonuses and FAR increases. And then something completely new, which is called the Opportunity Corridor Program, which is the planning department took corridors in the high resource area, which is a concept developed by TCAC, which is in large part areas that have higher incomes and therefore tend to have higher rents. And again, the city has provided incentives for unlimited density and higher FAR. And these are corridors that are presently downzoned to about 1.5 FAR, really not big enough to sustain new development. And the plan is for those to be increased to 3.25 to 4.65 FAR, depending on the corridor. So substantial increases in FAR, and with that, of course, there's an affordable housing requirement and some other requirements. But because of the nature of this area, these high resource, high opportunity areas, I think there are going to be some real opportunities for new development in those areas, because hopefully, the rents are high enough to sustain new development. If we see some improvements on the other aspects of a pro forma, interest rates, construction costs, labor costs, we might actually see some opportunities there. So that's a very positive development.
Yeah, I wanted to touch on a couple points. You raised lenders and investors, right? There's so much dislocation in the market right now. What are they underwriting? What's anything worth right now? And when you go back to measure ULA, right, that's a tax, and Mitch talked about the going-in tax on land transfers, but there's also the tax of time, because our process is absolutely horrible, governed by CEQA, and anything else any jurisdiction or NIMBY can throw at you. So when you take into account what you paid for your land, your time, and then you layer in everything that we were talking about, plus the tax on the back end, depending on where you were in that cycle, if you were able to underwrite all that in, and that's really starting now, but if you were developing and building over the last 3 years, you're upside down. So if you are a buyer of existing assets and you are going in and buying them on distress in downtown and surrounding areas, and you follow the trends that Moussa explained, you're probably going to be sitting pretty well, right? Significant discount to replacement costs. You've priced in the operating expense environment. You've priced in ULA, and your lender and investor have gotten comfortable with what those numbers are. But going back, it's going to be very, very difficult. And the system has to manage through that very efficiently in 2025, because a lot of those investors that were in those previous deals are also dealing with contingent liabilities like the rest of us are dealing with them. So if they don't flush the system, all these units that got zoned everywhere under the sky, I don't see how they make a dent in that over the next decade. It's almost impossible, because you need at least another 24 months to work through the system to shore up everyone's balance sheet.
That's a really good point, because when we think about, also the current owners and developers of that product, unless you're under distress, right, you're not moving. There's such a huge disconnect between where I'm priced and where the next person will be priced, right, once they've taken into account all of these hits to the value, right, that, again, it just feels like, and even just talking to people this morning as we were walking around, I say, hey, how's it going? Everybody's like, well, we're pretty locked up, right? We've got the stuff that we were kind of finishing, but when we look out over the next couple of years, what are we seeing, and where can we kind of start to make some progress? And so to your point, when you talk about kind of needing to get through the cycle, it's hard, right? Unless transactions are moving, right, and capital is moving.
And to add to that point, you have to, what are the forward-looking contributors to that? It's architecture billings, okay? And I read an article, I think it was yesterday, they're the lowest they've been nationally and falling off a cliff in 2025. So, okay, if that's the case, people are burning off pipeline. Non-institutional, institution stuff is going, right, this is specific to multifamily. You need that time to catch up and to get going again. So which means the size of these projects, you're another 2 years out, at least. Because once you stop, you're behind, which puts you further behind the curve on what Mitch was explaining, which was trying to solve the problem of producing more units.
Right. Hence Moussa's projections about rent growth, right?
I would like those projections to be rounded up a little bit more. But.
Yeah, I guess that was the question I was going to ask. So do we think that, boots on the ground, that at least in LA, and I promise we'll move to other places, but do we think that the rents could be a bit higher than where he's sitting, or do we kind of agree that this is roughly where we are?
I mean,
it's population, you're losing it.
Yeah, exactly. I mean, rent growth has always been very low in LA. I mean, Rich and I, we talk about it a lot. What's really contributing to the rent growth? Maybe you guys can help us, because I'm even looking at city of Los Angeles. I mean, rent is not growing by as much as allowed under current regulations. It's just growing by about 1%. They can still grow much faster, but it's not taking place. Why is that? I mean, we have been asking, ourselves this question. But let's not forget that there is a lot to be optimistic about in this market, and there is a lot to be optimistic about the economy. I mean, this is, compared to where we were, let's say 12 months ago, so we should really feel good about the next couple of years.
So Moussa, for example, question for you. San Francisco lost 55,000 people. I think we've gained 10,000 back. What's the number for LA specific county?
LA
Because
County,
250,000 for the state is a big number. You take 50-something thousand out, or 40, half of that, or 50,000 from San Francisco. What's it mean for some of these other areas?
Los Angeles, we are talking about $88,000.
So
$88,000.
almost double. So
Almost
that's
double.
why
Yeah.
you're not going to see the rent growth, right? Psychology's changed with work, right? And until these offices populate and it's a safe place to be, it's going to be hard to generate that. And you also need convention business to create the energy on the streets, which help propel the retail and the restaurants and keep this area vibrant. Without that extra population, daytime or otherwise, your hotels, are going to struggle as well.
No doubt.
Well, you had mentioned Koreatown, Hollywood, Studio City, that these markets were performing better and that they were kind of to be emulated. I'm curious from the panelists and for you in what regards do we see them to be emulated? Obviously there's a lot of development. Is this at the kind of local politics level where they're wanting more development and working with developers more, or is this, because of just the wonderful locations of the new transit or some combination thereof? When we think about the strengths of those markets and others perhaps that come to mind of, we know Culver City and others, so.
Yeah, it's so erratic. It's very difficult to predict submarkets within the city of LA of where development is going to occur. At one point, downtown was a huge recipient of a tremendous amount of new development and investment, and that I agree with Moussa entirely that the city should be capitalizing on the opportunities in downtown. There's very little pushback to new development downtown as opposed to other areas, but that seems to be stalled for a while at least. Another positive aspect in the entitlement process, in the regulatory process, is the benefit of some of the legislation coming out of Sacramento that continues to expand the density bonus law, the Housing Accountability Act, even some CEQA reform, which allows developers to go into the city with some leverage, in a sense, being able to say that we can use the density bonus law to waive some development standards, and by being able to satisfy that, we're able to use the Housing Accountability Act and tell the city that they have to approve this project because we meet all the objective standards. That's a huge difference. In terms of the regulatory environment statewide, that's really a sea change from what it was even 10 years ago, when you could walk into City Hall with a developer and have the city tell them, we'll support anything, but as long as it's not residential, and especially if it's not multifamily, because and they had the ability through discretionary approval processes to kill those or downsize them so that they didn't work. So that's very different, and that's very applicable in the city of Los Angeles. I think the challenge in Los Angeles is our rent's going to be high enough to sustain new development. Mm-hmm. And I'm curious from Gino's perspective, how far off are we in terms of rent growth? Again, knowing that there are very specific neighborhoods, a lot of different neighborhoods in the city or elsewhere, even looking into Orange County or San Diego. What are you seeing?
Let's take them one at a time. If you look at downtown Los Angeles, again, we have a labor problem, and construction costs are up 40 to 45% from, let's call it 17 or 18. That doesn't account for the increase in interest rates or the operating expenses, which the industry has had to absorb. So when you put on labor requirements with all these extra housing, some of them don't include it, but most of them by and large do. The only product that you can build with those density bonuses and clear the way for is affordable housing, right? And everyone knows you need subsidies for that. Those are hard to come by now, but you can get through the system faster, which helps that product. Same issues with that product as well, operating expenses, right, and construction costs. And so, we're delivering about $1 billion of product, right? Santa Clara, Santa Rosa, and Santa Monica between now and the end of next year. I would say on the margin, we saved anywhere from 5 to 7% not the 15%, 18% that we saved coming out of the great financial crisis. But we saved that money coming out of the great financial crisis, but you also had free money, okay? So we're not gonna have free money, okay? Expenses can't come down, we're losing population, and costs are maintaining. So it's gonna be very difficult to make deals pencil, right? So now you're into maybe potentially a condo execution in some markets because A, you can afford to pay land, right? You're building smaller buildings by and large, but there is an unmet demand for home ownership, right? You know, the difference between the rent and own is pretty significant now, especially in Orange County. It's off the charts high. So there's a huge demand for apartments there, but you know, there's been rezones and things. So that will actually, I think, perform well, you know, well in, you know, beyond 2026, because you just can't build housing. And now, you know, your entry price for a home is over $2 million. So there's a lot of dislocation here across these markets. And the jugular is the population. What happens? Because it keeps getting more expensive. You know, so you build apartments to maybe fill that gap, but is that how, you know, this is going to work over the long term? I think that's the question. You know, I think, again, getting back to like, when does all this absorb and settle down? It's a combination of everything. I would say costs have to come down 10%, maybe 15 if you can get them there. Interest rates need to come down to 200 basis points, right? Expenses need to settle down. This is the first year in 4 years where our expenses were flat to up to 1%. In the past, they were up 15, 20, 24%. And if you look back in multifamily over 25 years, you had a declining interest rate environment, but you had operating expenses that bumped around between 2.5% and 3.5%, okay? COVID happened, inflation, all these other things happened, and they went up 40%. Well, and your rents are down. So all of that needs time to recover in order to substantiate that. I think what's more important, at least specific to downtown LA, is encouraging businesses. Do whatever you can to get businesses back downtown, okay? Century City is full, West LA is full, Beverly Hills is full. Very expensive because people consolidated out of downtown LA, but this is the majority of the housing. So if they lean into that with tax incentives, okay, the policing, have a plan for dealing with or better controlling the homeless situation, downtown will get there. I mean, you know, a lot of us in this room went to USC and it was like, it had its moments right before COVID. And COVID completely gutted it. It's very disappointing because the infrastructure there, quality housing was built. You know, the office market, you know, always hovered around 20% vacant. But, you know, you had restaurants opening up, you know, by the month, and there was a scene here, and it was a place to drive to and go out to. And right now, it's not there yet, and it's lacking energy, and it just needs to get that back.
Great comment. Thank you. A rousing round from the audience. So let's move a little bit away because we started to kind of tiptoe into Orange County a little bit, and we had talked about, you know, some of the challenges that Orange County is facing as far as outmigration. And even on our earlier call, we talked about, you know, that rents are kind of reaching this funny tipping point where at some stage, you can't get any more kind of blood from that turnip. You know, you can't, you know, blood from the stone of like, hey, how do I move rents forward if I, you know, we're adding some supply. But just given that scenario, I'd love to talk a little bit more about kind of what's really happening in Orange County. Maybe some markets that are performing, or submarkets or aspects of Orange County that are doing better than others, and how do we address some of those challenges, and what are we seeing in Orange County?
I mean, let me start. I mean, I am very bullish on Orange County.
Yeah.
One, I'm from there. I understand the lay of the land. Number two, housing has gotten very expensive. And three, the fundamentals down there are just very good and tend to get better. Schools, policing, none of the issues we're dealing with in downtown LA. It's better for family expansion. Commuting from there is easier. There's lots of different transportation nodes you can, you know, deal with. We just recently entitled a 41-acre site, just completed it, knock on wood. We have our last appeal period ends next week. That entitlement is directly across the street from South Coast Plaza. It includes an entitlement envelope of 3,750 units of multifamily, 350,000 square feet of lifestyle retail, a hotel pad, and a senior living pad. So we're trying to create the place next to an economic generator of South Coast Plaza that I think tipped the scales at $2.5 billion of revenue. In addition to that, they are now investing on their old Sears parcel. That is considered the center of Orange County, the cultural core of Orange County. So everything that you would want to have in that location, meaning walkable by Orange County standards, right? You have the arts and culture, you have retail. We're going to create an environment there that supplements what's already there, which is an aging 500,000 square foot retail center. And we plan to build this out over the next 7 years. But the fundamentals down there are very good. Investors like it. There's no ULA tax. Your operating expenses are more in line and controllable. And you have a property tax environment that's fair, right? You're not constantly in LA getting overassessed and spending 3 years to go appeal to get a fair assessment, right? So when you put all that together in that location, and then you know, and you're only 7 minutes from the coast, which gets very expensive, which most people want to be, but it's filled up. You know, you see what Moussa's research said, Anaheim, Santa Ana, that's where the rent growth is going to occur. And it's largely been an area in Orange County that's been overlooked because not a lot of people have developed there. And when you look at asset value in a long-term horizon, your predominant landlord down there is the Irvine Company. They don't sell anything. So that's 94% of the stock, the multifamily stock. I think the next 3 or 4% is institutions, pension funds, which really aren't sellers, and the rest are mom and pop. So there's not a lot of trades that happen down there. So asset values maintained and cap rates are usually lower than historic norms, regardless of interest rates. So when you look at that, and if you're a long-term owner like we are, and you're trying to place make and do what we do, fundamentally long-term, that's where I want to spend our time. And
So-
second to that is San Diego.
Well, I just wonder if the forecast for Orange County should be more positive in terms of units to be developed. I mean, what Gino just outlined applies to a large part of the county. And the fundamentals are so different from what we were just talking about in the city of Los Angeles. I'm just wondering whether it's land use and regulatory constraints or other things that are account for the forecast.
Yeah.
Orange County is going to benefit from LA.
Oh, definitely, definitely. Orange County is going to benefit. But, you know, just going back to Gino's point, I think the fundamentals are really great in Orange County. I mean, the issue has been really adding supply. I think the market structure, and kind of we alluded to this in our report, the market structure seems to be, you know, restricting supply in that market, okay? So that's what Gino was kind of alluded to. But no doubt, if you can really add supply in Orange County, there is no better place to invest.
Well, and getting to the regulatory piece, I mean, is Orange County, it's typically been, you know, the bedroom community, it's been, you know, very low densities. Are you seeing responses from different cities, different, you know, councils that are excited to push density and excited to kind of take the charge and deal with some of the, you know, state mandates and really address some of the NIMBYism and all of that that's been kind of typical in that kind of environment?
Or you want to go?
Well, I was just going to say, I mean, this might be a good segue to move to San Diego because, you know,
Everyone loves San Diego.
That city is really exemplary in the way it has embraced the challenge of building more housing. Even outside of the housing element process, the city adopted what's called the Complete Communities Program, which is in many ways what I wish the city of LA had done with the citywide housing incentive program, because it's really citywide. It increased FAR and eliminated density in large parts of the city. I mean, 4 different tiers ranging from downtown with no FAR limit to employment areas that have an 8.0 FAR, and then another tier is 6.5 FAR, and then finally just a generic transit area has a 4.5 FAR. and even the coastal zone was upzoned. And they've eliminated, they're able to waive a lot of the development standards. The city even committed for most of those projects to approve it ministerially, meaning no CEQA, in an administrative process, meaning no hearings, and commit to do that in 30 days. And it's really taking off. I mean, there's a lot of competition for those sites. Sites are being built, underway. They're forecasting another 8,000 units. And this is a long-term kind of plan that addresses the regulatory issue and would provide a tremendous amount of production over decades, really.
And so what's helped coastal communities in Orange County and Southern California is the regional housing needs assessment, right? All of these cities had to rezone, create units, and most of the coastal cities said, no, we're not doing it. They were forced to do it, which is opening up opportunities, which is kind of where it is right now because there's higher rents on the coast. You can afford to pay a little bit of land. You're pricing in all the other things that we've talked about, but that's been helpful in areas that you couldn't otherwise develop. Case in point, Newport Beach, Irvine just rezoned, Huntington Beach and the like. And so that's helpful in terms of creating more units on the coast.
Yeah, but do you see more units coming into in the coastal cities in Orange County?
They've just finished a bunch of rezonings. There will be, yes.
Okay, that's good.
Right.
That's
So
good.
Newport Beach just updated their general plan. They are going to continue to densify the airport area and Fashion Island. So that's another 3,000 to 4,000 units. I think Irvine just did their update between IBC and others. That's another, I think I have these numbers right, 35,000 units. Okay. Santa Ana's done a very good job. They've delivered, 3,000 units. We have 3,700 units on our site. Dana Point is doing that. They would have never have done that if they weren't forced to do it, right? They don't want the traffic. You have old guard in these cities. It's traffic, and then you can't get anything through. So that has been helpful.
Because recently, San Diego County has done much better than Orange County in terms of adding more supply. And San Diego County, whatever they have done definitely needs to be emulated by the other counties. San Diego County added twice more units than Orange County.
I think that's a COVID phenomenon, right? Yeah. That following COVID, that blew up down there, and a lot of employers moved down there. Yeah. And why Orange County is becoming a beneficiary is largely due to LA, because back in the day, if you were from LA, you never went to Orange County, you never went to the Orange Curtain, there was nothing to do down there. And during COVID, when it was open and LA was locked down, a lot of people from LA decided, wow, this is a great place. Drove up housing prices, drove up vacancies, you had 20% rent growth, and then the infrastructure followed. There's a lot of the same restaurants in LA are now in Orange County, Newport Beach, Irvine Spectrum. So you kind of have what you have there. You may not be staying up until 2 a.m. I don't do that anymore. But at least you are getting, you have a bit of a food scene down there and things to do. The weather's great, but what is the deciding factor in all of that? It's safe, you have great schools, and you don't have a homeless situation.
Well, and
it's pretty simple,
you can
right?
see it in terms of more kind of, we like to think of like normal markets, right? So Inland Empire and San Diego are functioning more like a normal market, right? Where you see a big demand, we see increase in supply, then we see the rent growth maybe slowing a little bit, vacancy kind of coming up a little bit, then an absorption period, then we see more, and we're so locked up in LA, and it's become really just an abnormal market, right? That those kinds of markets are seeing that, and as you had mentioned before, Orange County is experiencing out-migration, but it's really because there's no place to go, as opposed to people don't want to be there. Right? So if we can respond in that way with a more normal market response of increased supply, then it should reverse that, it sounds like.
The reason why we couldn't build through this last cycle is because banks were shut down, interest rates were still high, people are still trying to deal with operating expenses. So you're going to start to slowly see that, but the reality is there's only going to be the larger firms, including the Irvine company down there, they can really start something, right? Yeah. Merchant building, right now the margins are squeezed because of the cost of money and the operating expenses. So it's gonna take a little time, and which I think is going to increase the demand, right? But there's only so many places you can go.
Yeah, it's good better later than never, to be honest.
I mean, I'd like to see 6% rent growth next year, but I'll take 3. It's fine.
Well, I know we're a little bit behind, so I'm checking on clocks and all of that, but I would love to open up for questions.
Mitch, on the ULA, has it been settled as to what happens with the deed in lieu or foreclosures, whether it has to be paid going in as the lender?
That's a good question.
Pay again.
Yeah, there's still some uncertainty around that. So I think a trustee's, and to some extent, this follows the ordinary documentary transfer tax, but we now have the City of LA's Department of Finance, which is going to be ultimately resolving this. But as I understand it, the trustee's deed is not subject to it, but when the lender then sells the property later, it's subject to the measured ULA tax, which is a huge disincentive for a lender to have to take on that tax, simply trying to recover its principal. So that's definitely an example of adding insult to injury. But yeah, generally, it follows the documentary transfer tax.
One of the challenges that we have is we lean heavily into these state laws that allow us to build in these tougher communities. We're running into problems where as soon as, for example, Newport Beach adopts their housing element, it's immediately sued by 4 different parties who don't necessarily have a desire for it to be resolved quickly. What advice do you give your clients in terms of underwriting that amount of risk, knowing that we might not have a housing element that's enforceable at that point?
Well, that is a challenge. I mean, you can, I'm part of a team of 35 land use lawyers, and we do, review the housing element. I think we're able to underwrite to some extent, the validity of the lawsuit and whether it's likely to succeed. I mean, in general, those are very difficult lawsuits to succeed with. But, like anything, there are no guarantees. And the litigation is probably, 12 to 24 months. So it is a real area of uncertainty.
Option out your land.
Hi, this question is for Moussa. So in terms of out-migration, and in particular here in Los Angeles County, was there a difference between homeowners versus renters and by income band in terms of out-migration?
That's a very good question. And I don't have the breakdown really between those different groups, but homeowners tends to be really more, more stable, less likely to move. We are really talking more so about renters, okay, because that's what we are focused on mostly. And this tend to be really, people at the lower end of the income distribution than really people at the higher end, because those people can really, you have a lot of options in Los Angeles, honestly. Coastal cities, coastal communities are very, very good locations to relocate to. So for high income earners, definitely it's not a problem. And again, we are talking about this tight market, but it's a lot more, you have a lot more vacancy at the high end of the market, and people have options there. People who really don't have options are people at the lower end of the income distribution, and those are people who tend to be moving to the Inland Empire or cheaper places in Texas, Arizona, or Florida.
In LA, according to Dr. Diop's report, they're not taking advantage of the rent increase allowance, even though they can increase rent, which makes it difficult for investors or builders to want to invest there. However, there are other underlying factors, such as lack of employment. The Baldwin Hills, for example, is dying. All the tenants are moving out, and even all the surrounding. So there are no jobs. You have college students graduating, coming out of college, and they can't afford that kind of rent, $2,000. They're probably going to be offered $80,000 to $100,000, net income of about maybe $40,000. They cannot afford rent in that market. What regulatory incentive do you think need to happen to incentivize those college students, because that entire community is also gentrified, unfortunately. Yeah. And you have all these people building houses that nobody really can live in it and charging high rent. So what incentive needs to happen so that this the youth, because we're talking about youth market right now in terms of housing and affordability. Yeah. What needs to happen for them to be able to stay there?
Great question, and you're hitting the nail on the head. Bill Whitty, my partner and former chair of Les Center, is in the audience here. We have been talking about this for years. We talk about it as the missing middle. Okay, we need to produce as much of that housing within the state of California as we possibly can, for the reasons that you just said. So what do we need to do about it, right? We have to deal with expenses. We have to deal with the construction costs. There isn't a plug to make the numbers work, right, in order to substantiate that. So there needs to be, in our opinion, a bond floated to subsidize that over a period of time, number one. Number two, I think they need to abate property taxes for a period of 20 years, similar to what they're doing in New York and have done in the past. Okay, that will bring down the costs and get a yield to a place which makes sense. If we could solve that, we could build that all day long, twice on Sunday, 3 times on Monday. And that's when you are looking around downtown LA and all of these centers for employment, that is what's missing. We're doing one right now, it's just in Santa Rosa, but we're doing it with our own equity. And the reason for that is we're in a downtown setting where the city is like open for business. They're not charging fees over the 3rd floor. Land is less expensive. Okay, you have rent growth in that county, significant. You have a demographic that supports that growth, and so we price these apartments to be middle income, 80 to 120% of AMI. Okay, not 140 to 160. And we back solved to that. There were some other monies available, but in conjunction with the city, moving the entitlements through, as efficiently as they can, and doing all of that, our check size relative to a $100 million deal is pretty reasonable, and we were able to generate a yield that afforded us our ability to take the risk. But the most compelling is the cost to build there. I mean, we're building that unit for less than $400,000 a unit. We're all in for less than $500,000. You can't do that in LA. You can't do that in San Francisco, because if you're taking advantage of these density bonuses and everything else, time is your killer. ULA is a problem, right? ULA has to be exempted for middle income as well, right? And your interest carry is still too high. But yes, you're exactly right. That's what needs to be the focus for the next decade, is how do you solve that missing middle? 100%.
The subtext of a lot of what you're talking about today is the great gulf that stands philosophically between those who actually build housing and those who make policy. What's an answer to that divide?
That's a great observation.
Fire all the people that make policy.
Well, particularly in Los Angeles, because that's a great observation. I think there needs to be a tremendous amount of dialogue and education so that the decision makers actually understand how, in the real world, private capital is used to build housing. Yep. And that they understand how essential that is to solving the housing crisis and dealing with the supply issue. And there is a huge gulf at the time, but I think the only way to approach it is to start the conversation. I think, unfortunately, real estate development is very mobile and very flexible, and Gino's a perfect example of how many different places it can operate in California, but even all the markets outside of California. And I think we've got to get the real estate developers and investors who are committed to Los Angeles to participate in a sustained effort to have that conversation. I mean, this is going to be essential to improve Measure ULA and to reform it in a way that it actually isn't suppressing the development of more housing. So that's where I would start.
Lenders and investors are probably the most important component of that today. They never want to hear from developers, right? We're big bad developers, we're greedy, we da-da-da-da-da. I mean, you hear it time and time again. But we can't do anything without them. And the reality is they could educate the policymakers about how they would invest, and they could set up a programmatic venture with the big ones, the Blackstones, the BlackRocks, and you have a partner like that combined with a partnership with a city, and you get the policy set straight, we could take off.
Yeah.
But that extra tax of ULI and all this other things and the time and so on and so forth, it's just scaring people away because you have these other markets where it's a lot easier to build, and our people are going there and they're taking rents up and there's good returns.
I just had a speaker come to talk to my class, my real estate market analysis class last night. And they had been working in LA a long time, and they did a project in Cary, North Carolina, added thousands of units, and they were shocked when the folks at the city said, "Thank you so much for investing in our community. We're so excited about this project." And they were like, "Whoa, okay, let's do that." Okay, so last question back at.
Hi, I have a question for Moussa. You mentioned that affordable housing issue will get worse as interest rates come down. Can you elaborate on what the correlation is?
No, what I mean is this, is that, if you think of it, from the perspective of someone looking to buy, a lot of people have been kind of sitting on the sideline waiting for the cost of basic owning to kind of decrease a little bit before they jump in. And those people will jump in as soon as interest rates starts going down. But you have a lot of people out there who own houses who are not going to sell because they are already locked in. They have interest rate at below 4%, sometimes even below 3%. This stat I have is about 6% of people are sitting on mortgages at below, 3%. Those people are not moving anytime soon. Interest rate will have to decrease by at least 200 basis points before those people can think about selling. So that's the problem. And supply definitely will come, but it will take time. So in the meantime, the market will get just a little bit tighter.
Okay, well, on that note, we are going to close out our panel, and we'll turn it over to Sean Burton and his panel and go from there.